Welcome back to our KPMG Africa Conversation series where we're discussing transacting in Africa. We still have in studio with me Eloise Smith. She's the Executive Vice President Business Development at Standard Bank. We have Alan Field. He's Head of Tax and Legal at KPMG. And we're joined now by Carl Smit, Africa Head of Energy and Natural Resources at KPMG. And joining us from our Nairobi studio is Segun Olujobi. He's the Chief Executive Officer of Vertex Energy. Thank you so much to Carl and to Segun for joining us for this segment. Just before the break, we were discussing whether Africa is starting to be seen as regional plays. Do you think that is the reality, Carl?
Yes, Bronwyn, but the one thing that we must remember, it's not only by geography. We have French-speaking Africa, we have Portuguese-speaking Africa, and we have English-speaking Africa, and that is also important in those regions.
Segun, I apologize. So, of course, you are in Lagos, in Nigeria. I'm losing my mind this afternoon. Just in terms of bringing you into the conversation, how do you feel about the strength of ECOWAS as a regional play when it comes to transacting on the African continent? Are people starting to come in and say, we want to do a deal within the West African region, or are they still very country-focused, as in, I want to deal specifically in Nigeria, I want to deal specifically in Ghana?
I don't think it's an easy question to answer, and that's partly because officially I think it's the barriers, the countries are not quite as integrated as the ECOWAS charter would want it to be. Informally, however, I think you find that trade does move across borders, and you find that things that are produced in Nigeria find their way across the borders to other neighboring countries. So I think the answer is it's in between. I think people still tend to think country, but obviously a lot of trade happens informally.
Alan, let's get you to give your opinion here as well. Do you think that it is slowly in between, that we're starting to look at regional blocks?
I think if companies are going to trade within a region, they'll access the opportunities that trading within that region makes sense. SADC, for example, will assist with trade within a bloc. But I believe that if there's an opportunity in an area that a company wants to invest in, they'll access that opportunity. It's not going to restrict. I agree that it's difficult to just put this in a particular category and say, because there's a block there, we're going to go into that block. It's just not how companies invest. If you're in a block, East African block, they probably will access opportunities. Remember the idea here, like the European Commission, it's designed to promote free trade, but there's no one investment that's exactly the same as another investment. Nobody's going into the European economy and saying, here's the European Commission, I'm going to go in there. It just doesn't make sense.
And perhaps the reality is also the regional blocks aren't integrated to the extent that perhaps we think they are.
Certainly, I think East African community, I have to agree with the previous speaker, is definitely leading the way in terms of also zero tariffs, which is ultimately what it is all about, and the free movement of people. What we see with many of our clients, they will look at especially South African companies that are looking to access the opportunity on the rest of the continent. They will broadly think the Southern African opportunity can perhaps be accessed from South Africa, whether it's a trade or a slightly into the BL nest countries, etc. Then they'll look at East Africa much more as a bloc, given the amount of integration that there is. The question then is, can you access Tanzania from a hub in Kenya? And should we go to Tanzania and then access the rest of the bloc from Tanzania? West Africa is a different conversation. I think especially for South African companies, unless it's resource-based, in which case you will follow where the resource is. If it's Guinea-Conakry, that's where you will go. But they will look at the West African opportunity, and the reality is just Nigeria by its sheer size dominates that market. And then they will say, maybe, and it's all perceptions with many investors rather than facts, they may think that Ghana is an easier entrant than in Nigeria, albeit they ultimately would want to be in the Nigerian market.
Segun, obviously in the first half we had a focus on East Africa and specifically Kenya with our guest from the Kenyan Banking Association. I think it's important, sir, to try and get your insights into what is happening on the transaction front in Nigeria. On the ground, what are the hot spots?
Well, I think traditionally, I mean, the hotspots have been oil and gas, because that's been the mainstay of the economy. But interestingly, in the last couple of years, I'd say in the last 5 years, oil and gas has actually been on a decline year on year for a variety of reasons. First, it was insurgency in the Niger Delta. Second, after that was resolved, was a lack of clarity around policy with the bogged down petroleum industry bill. So actually, growth has been more in the telecoms area. And the story about MTN is a well, publicized story. But I think the story is more than MTN. I think it's been the old telecoms area. And I think it's the old consumer area. And that's because, for many years, the Nigerian economy was sort of mismanaged and not run properly. And each time you take or reform a sector, the pent-up demand in that sector just shoots up. So we've seen telecoms, we have seen some growth in retail. And so the hotspot has been sort of the telecoms, retail, sort of consumer goods area. Energy is big, but it's really on a year-on-year basis for the last 5 years actually been going down. So that's the way I'll characterize the growth of Nigeria and the things that have happened in Nigeria in the last 5 years.
Well, obviously your portfolio, sir, speaks to energy, gas, resources, and there, Segun just saying that we've seen the response in terms of energy perhaps diminishing and consumer focus is coming to the fore. Do you feel any pullback in the energy space? Of course, there's no conversation without Africa in terms of resources and oil and energy.
Bronwyn, this for me is really very important. Africa is so rich in minerals. It is a fact that 30% of the globe's minerals can be found on the African continent. And whether we're talking oil and gas, with new discoveries daily, especially Mozambique, very exciting what is happening there. But if you look at the array of resources that you find in Africa, platinum, 80% of the world's platinum in southern Africa, manganese, gold, 50% of the world's gold you find on the African continent, 4% of coal. So what I always like to think and say, a resource-hungry world cannot ignore Africa. And why resource-hungry, Bronwyn? Population growth, urbanization. We need resources.
Earlier in the conversation, we spoke about tax regimes, about nationalization, and Alan was of the opinion, correct me, so if I'm wrong, that this is part of the conversation you have with investors that are thinking of going into the space. It's part and parcel. It doesn't come as a surprise. Do you reiterate those sentiments?
Bronwyn, something that we have to get right on this continent is youth unemployment. There's huge social pressures all over our continent to make sure that there's jobs and there's a future for our youth. And as long as we sit with those problems, I believe nationalization will be a discussion topic on the table. Whether that is the best way, that's another argument. But as I say, we see that all over the developing world, not only in Africa, we see those arguments in South America as well.
And I think that was the point that Alan made. We just had jumping the gun, our audience, on our questions. And Mark Zander saying, what is the potential of FMCG in Africa? Do you have any grasp on that? Again, it comes back to the consumer story.
It's a growing, there's the trends, as they say, about Africa. One of them is obviously the resources. Around that, you have the power and infrastructure development. But then driving it all is really, we've got a growing population that's increasingly affluent. There's a lot of debate about how you define the African middle class, but you can debate about what the definition is, but the fact is it's growing. And it's increasingly urbanizing, which makes it possible for the FCMG growers and other service providers to get economies of scale, because you're increasingly going to have cities in excess of 10 million people on this continent over the next few decades. So it's growing phenomenally, and we're seeing this not only from there's the Walmart into Massmart, which is they're well talked about, but we're seeing increasingly regional players growing, increasingly in East Africa going across. So we see it's fundamentally, and that in itself drives packaging companies, service companies to the FCMG. There's a lot of talk about Nigeria, and what we're seeing is as people move up, there's the desire to have different products and perhaps just in smaller quantities. So it needs a rethinking. A lot of our FCMG companies need to say we have a broader market, but we have to change our approach to that market and perhaps do single serving sachets rather than do the big 500 or 100 ml. That's no different from the telecoms industry, which has gone lower and lower into the denomination of top-up vouchers.
Sekun, earlier in the conversation we spoke about Nigeria trailblazing when it came to consolidation in the financial arena, specifically among the banks, and cleaning up that business environment. Do you think that that is now starting to translate to other sectors? Obviously, your position at Vertex Energy, are we seeing a cleanup of businesses across the board in Nigeria?
I think it's, I wouldn't say that broadly. I mean, clearly banking, the consolidation has helped, and from a client perspective, I think we're seeing more banks being able to do more transactions at scale, given the sort of industry I work in. If I take power, which has been sort of the albatross of the Nigerian economy, I think we're seeing major reform in that area. Now, I think over the next couple of months, we expect some of our big Gencos and Discos to be sold off. I think if that happens, I think we would see a major effect on not just on the oil energy sector, but across the board. I think because of the population we have, FMCG will boom. I think services will boom as well. So I think that's one area we're looking at. If I go to oil and gas itself, I think with the petroleum industry bill now going to Parliament, it might take some time to resolve. But once that is done, I think with the right policies, with the right fiscals, and with a greater focus on transparency and competition, I think you'd see that boom happening as well. So I think we're poised, all things being equal, over the next 18 to 24 months to begin to see some real growth across not just banking, but across critical sectors like power, which drives FMCG, across energy and gas, which also helps to either add more money for the country or provide gas for power. So I think the transformation is going to extend beyond banking, but I think the key ones to look at is what happens to the generation sale, the sale of the discos, what happens to the oil and gas bill around, and what happens to the fiscals there. Does it make it easier for you to invest in gas? Are we going to see production volumes go up and reserves grow over the next couple of years? Couple of questions to look out for. Clearly, if the power reforms happen, I think we'll see significant growth. And if the oil and gas reforms also on the back of the new bill happen, then I think you might see a new Nigeria that's really living up to its potential over the next 5 to 10 years.
Carl, you indicated you'd like to add to that conversation.
Yeah, I think if we look at oil and gas, and if we look at mining on the continent, you know, investors want certainty. We want to be able to model and predict what do we need to put in, what are we going to get out. So policy is very important. And not only that, we need to make sure for investors that there's law and order in all the countries in Africa, because you would at least want to know it's your asset that you're investing in.
Another question from our international webcast viewers, from Greg Knipe, saying, could he please get your views, and he's referring to all the panelists here, on the currency risk that we're dealing with in Africa. Who would like to take the lead on that one?
Can I make a short comment on it? I know, for example, that with exchange controls, you're investing in and what will you get out? And basically that's what investors are looking for now. Some countries in Africa, I think Kenya is a recent one, has recently changed or introduced exchange controls, and literally now you're investing in dollars and you're coming out in Kenyan shillings. Now that introduces risks, and so that makes for an investor introduces uncertainty that Coral's been talking about, that we've been discussing over here. So I think one of the things that investors and countries have to think about, and particularly the countries, is if we're putting money into these countries, we've got to make them as investor friendly as possible. In fact, between countries as well, we've got to become more investor friendly, because frankly, we don't really want the money to come into African countries and then get taken out again. We want it to stay there. And once we have exchange controls, once we have currency risks, it's a real problem.
Talking from a perspective of companies operating in the region, I couldn't agree more the appeal one could have to governments. The reality is, if you're operating on the continent, you are exposed to currency risk. There's an element of that if you are in the mining extractive industries. You then, since you are dollar revenues returned, you have a certain hedge. A company in the telecoms industry, for instance, to use an example, would be totally exposed. A lot of your inputs, your machinery, equipment, etc., will be hard currency based. You are importing this. However, your revenues, apart from very small roaming revenues, is local currency. And then it's a matter, how do you address that? Some companies, you can do it by matching your revenues to your debt, and therefore raising as much in local currency as possible. And this is where it's encouraging, where our local markets have really developed in many environments. And it varies greatly. A country like Nigeria, you can raise 250 billion naira in the local market for the right player. In a country like Rwanda, like Liberia, you have 5 banks, and each maybe has $1 million single lending limit. But really, so one aspect of it is to raise your money in local currency if you have local currency revenue. Increasingly, we have more exotic investors as well through a bank that can actually have appetite for Kenyan shilling risk, and therefore can be placed, albeit that you can't raise it in the local market. Perhaps you can access it differently. And then it's really a conversation around your industry and your appetite for risk.
And of course, Coral, this is very relevant in your portfolio, where currency has a huge impact on the resources spectrum and the volatility therein.
Well, you see, most of the mining companies will sell their products in dollars. And that gives them sort of a natural hedge. I say, if you go and play in somebody's yard, you play according to their rules, Bronwyn. You know, if somebody come into South Africa to come and do business here, you do it in rand, and you write up your books in rand, and you pay your taxes in rand. We can't expect anything different from any of these other countries. So if we go and play there, we look at the risks and we see how we are going to handle those risks.
Segun, if I can come back to you in Lagos, another question through from Jim Maples, saying, do the regulatory systems of African countries hinder transactions?
I think that's a very broad question. I'd say that from a Nigerian perspective, I think what I can say is that we're making progress to try and make sure that the policies are become more market-friendly, more transaction-friendly. And you've seen in the banking reforms that we've seen, you've seen the move towards even things like going cashless and using electronic banking. I think if I take the Nigerian perspective, the objective of the last 20 years of reform has been to make the markets more friendly to investment. Of course, we've done it in flips and flops. We've gone 2 steps forward and 3 steps backwards sometimes. But I think the general trend is that we do get it as a country and as a people. And I think that I speak for most countries. I think generally speaking, people have realized that the issue is about investment. Investments create jobs, and investment will not come if investors are shackled. So I'd like to think that generally that message is sinking in regulators, in businesses, in policymakers. And I'd like to believe, and I think so, that over the last couple of decades, Africa as a whole, and Nigeria specifically, has made progress.
Just a thank you to our international webcast viewers who are sending through their questions. We appreciate the interactivity. And of course, we also have a live audience here at KPMG in Johannesburg, and we're going to open it up to the floor as well. Do we have any burning questions from our audience this afternoon. We do so.
My name is Francis Osuya. I'm the Chief Executive of Frost Capital. The question I have for the panelists relates to indigenization and local content. Now, the question is this a trend, or is it a trend that is likely to spread across the continent? If it's a trend that will spread across the continent, I'd like to know how this can impact local growth and empowerment as well as job creation. Thank you.
Carl.
You know, we talk, Bronwyn, about resource nationalism, and this is something, it's a trend that we see globally. We want something to be left behind in our countries. We want to be part of this growth. And I think what we see happening in Africa is definitely an indigenization program. And I think we will see more of that globally and in Africa. And that is just one of the factors that you need to put into your model and see whether it kicks out the answer that you're willing to live with.
Anybody like to add to that answer?
Yeah, I think there's definitely, a couple of years ago, it was only if, say, in the telco space, there was a legislative requirement to have a 30% local partner that one saw that. Increasingly, I think there's a realization by investors of the value that local partners bring. I'm pleased to say that Standard Bank were recently involved in the funding of one of the first indigenization in the oil industry in Nigeria as part of that program. So again, that creates an opportunity in itself.
We have another question from our audience.
Thanks. Almost related to, my name is Lebu Malatleha. Almost related to the previous question, I know we've been talking investors, but it looks like we've got a lot of investees in the room. Yeah. Alan, you mentioned that we don't just want money to come in and then leave Africa. We want it to stay in Africa. Exactly how do we achieve that? Can you just give me a practical example of how we achieve that? How do we advise our investees to make sure that they get value and they remain with value in Africa?
It's really a related question. My name is Tsidi Mokabudi from KPMG. I just want to understand, you spoke about the shifts that you are also seeing, whereby there are new developments in some countries like Uganda of the natural resources and so on. I want to know, to what extent then is the FDIs following those type of shifts and trends? If they're not right now, what's your view going forward? Are the FDIs really still following the so-called gateways in terms of South Africa or Nigeria, the big ones, or are they following where these new developments are happening?
Sigun, can I get you to comment on this? Is FDI following the hotspots in Nigeria? And then I'll bring it back to the panel here in Johannesburg.
I'd say absolutely. I mean, if I start from telecoms, FDI, MTN has put quite an amount of money in this country over the last couple of years. They've done that because they've seen returns. They've seen that there's potential for returns. After MTN, we've had Etisalat come in recently. So that's just an example. If I take the oil and gas sector, for example, when the policies were right in 1993, when the first set of PSCs were signed, investments rushed in. In the last couple of years, investments are slowed down because the last couple of PSCs that we signed were not quite as attractive. And the last couple of years, with a lack of clarity on policy, they slowed down. If I take East Africa, for example, because the policies have been right, because the fiscals have been right, you've seen money pouring into Mozambique, into Tanzania, into Uganda. Mozambique, there's estimates say between $20 and $50 billion are going to go into that gas find. Almost 100 TCF of gas found in the last couple of months or year or two. So I think investment is going after real opportunity. The truth about it is that we're well positioned. The rest of the world is slowing down. Europe is in crisis. The US, the returns are low. It's only Asia and Africa where the returns are there. And if you take resources, if you take oil and gas, for example, Africa has one advantage in like all the minerals, but oil and gas specifically now, that this is the most open continent. Our NOCs are not as strong or established. The continent is still open, so you find, and we're close to Europe, which is a growth market. We're close to the Atlantic, and on the eastern side now, yeah, we are growing. So
my apologies.
Is growing there.
My apologies for interjecting. I'm just cognizant of time. I've got 4 minutes to the close of our conversation. I want to bring it back to Johannesburg and answer the first part of the question: how do we keep the money in Africa?
All right. I think the one important thing is investors want to have a secure investment. They do not want to lose the funds. It must be more attractive for them to keep their funds here than to take it out. And I think in many jurisdictions you find that some of the things from a tax point of view may make it unattractive. Security comes from the fact that they must know that in that environment they have the frameworks that we spoke about earlier. I heard just yesterday about a 20-page tax legislation in a particular country. Now, it's just crazy. Why would you keep your money there when you don't know what the government's going to do in the next 5 years? When you don't know what and I'm talking legislatively, when you don't understand how the regulatory environment's going to look, when you don't know the legislative framework, and I'm talking beyond tax. Tax is just a slither in that framework. So we need to make it more certain. And typically it's safer to keep the money where the whole environment is more developed than where it's uncertain. And so we can't force investors to do anything. What we can do is what the African tax environment, the African tax ATAF is doing. It is working with the different governments to try and develop a platform of tax environments where everyone is working in a much more equivalent tax framework. And I think that would assist.
It comes back to your point earlier in terms of certainty. We have got 1.5 minutes to the end of our conversation, and Julia Briefs has come up with the perfect question, which you all need to answer, and you all need to answer it in round about 30 seconds, including our Nigerian guest, Segun. Segun, I'm going to start with you. Julia Briefs saying, if you had $100,000 to invest on the African continent, where would you invest it right now? Segun, starting with you, then we'll go through Carl, Alan, and Eloise.
I'll be looking to put it either in Mozambique or Tanzania.
Very nice, short, sharp soundbite there. Thank you very much for following my instructions so well. Carl, from your
Ron, when the
perspective.
textbooks say split your risk, I will not split it. I will go for Mozambique with their gas discoveries and with their coal discoveries and with the development of their coal fields. I think it will be a very safe bet.
Can we get more takers for Mozambique? I feel like I'm going to be auctioning off the countries here.
If I had $100,000, I wonder where I got it. But all right. But having said that, I'm going to be patriotic, and I'd put it in South Africa.
I like that patriotism.
I would go in a sector rather than and I would put it in the agribusiness sector, because I'll have a long-term view, and I believe that's one of the sectors that we don't pay enough attention to.
Just very quickly, to that point, are we seeing people really delving into the agri sector? We've got about 20 seconds.
We are seeing it, perhaps more on the, the agri sector goes all the way from farm to fork. We're seeing more at this point in time closer to the fork in agribusiness rather than perhaps emerging farmers, but definitely a growing area.
Thank you so much all for your time, and I think on that note it brings us to a close with the KPMG Africa Conversations series. We've been addressing transacting in Africa. Thank you so much to all my guests, and of course to Segun in Lagos in Nigeria. Thank you for your time and your insights, sir. Thank you so much to our international webcast audience and also to our live audience here in Johannesburg at KPMG. That's it for the KPMG Africa Conversation series. Until next time.